Welcome back to the Daily Crypto Roundup. Today has been one of those days where, if you've opened your portfolio even once, you've probably felt that familiar sinking feeling. Red candles across the board, confidence shaken again, and the same question quietly forming in the back of people's minds. Is this just another shakeout? Or is something deeper going on? Before we get into narratives, theories, or opinions, it's important we anchor ourselves in facts. So let's start with the top 10 cryptocurrencies by market cap. Bitcoin is currently trading around $78,000, down sharply on the day and well below recent highs. Ethereum sits near $2,390, continuing to struggle to regain momentum. Binance Coin is around $750, XRP near $1.64, Solana around $102, Tron roughly 28 cents, Dogecoin near 10 cents, Bitcoin Cash around $520, Cardano close to 29 cents, and rounding out the top 10 is Hyperliquid, trading near $29 to $30. Those numbers matter, not just because they tell us where prices are, but because they frame the psychology of the market right now. A move from 80+ thousand down to the high 70,000s on Bitcoin doesn't just erase dollars, it erases confidence. And confidence, more than fundamentals, is what drives short-term price action. Now, here's the first thing that needs to be said clearly. Nothing that happens in crypto happens in isolation. Today's move is not about one coin failing, one blockchain breaking, or one project collapsing. What we're seeing is a macro-driven risk-off event, layered on top of an already over-leveraged market. Zooming out slightly, the broader backdrop is uncomfortable. Traditional markets are jittery. Bond yields remain elevated. Liquidity conditions are tight. There are renewed murmurs around stress in parts of the banking system, particularly in the US, and whenever that happens, correlations spike. Bitcoin trades more like a high-beta tech asset in moments like this, not like digital gold. That's frustrating for people who believe in the safe haven narrative, but it's also honest. Bitcoin is still early in its monetization journey. It reacts to liquidity first and narrative second. Ethereum's weakness today deserves its own mention. At around $2,390, Ethereum is underperforming relative to Bitcoin dominance, which continues to creep higher. That tells us capital is consolidating rather than rotating. When markets are healthy, money flows from Bitcoin into Ethereum, then into large caps, then into riskier alts. Right now, that chain is broken. Capital is retreating up the risk curve, not down it. One of the biggest developments today comes out of Washington, where Wall Street banks and major crypto leaders are preparing to meet with US lawmakers over what could become one of the most important pieces of crypto legislation we've seen so far, the so-called Clarity Act. According to reporting, executives from large banks and leading crypto firms are set to sit down with policymakers as pressure builds to finally establish a clear federal framework for digital assets in the United States. At the heart of the disagreement is how crypto companies are allowed to operate alongside traditional finance, particularly around issues like stablecoins, yield-bearing products, and whether certain crypto services should be treated like bank deposits. Wall Street banks want tighter controls and clearer limits, while crypto firms argue that overly restrictive rules would crush innovation and push activity offshore. The reason markets are paying attention to this now is timing. These talks are happening during a period of extreme volatility, when confidence is already fragile, and any hint of regulatory uncertainty, or progress, can materially shift sentiment very quickly. At the same time, we've seen just how brutal leverage has become in this environment. One of the most striking stories from the last few hours is a single trader losing roughly $220 million after Ether plunged around 10%. This wasn't a gradual loss or a bad investment call over time. This was a forced liquidation triggered by leverage. As Ether dropped, the position was automatically unwound, adding even more sell pressure into an already thin market. This one liquidation alone highlights the real issue beneath the surface right now. The selling we're seeing is not primarily long-term holders panicking or abandoning crypto. It's leverage being flushed out aggressively. When positions of this size are wiped out, they tend to drag the broader market with them, triggering further liquidations across other assets. That's why moves like this often feel sudden and violent, even when there hasn't been a single piece of catastrophic news. Adding to the unease is what's happening in the traditional financial system. In the last day, regulators officially closed Metropolitan Capital Bank and Trust in Chicago, making it the first U.S. bank failure of 2026. The bank was placed into FDIC receivership, and its deposits and most of its assets were transferred to another institution in an orderly resolution designed to protect customers. Depositors are expected to retain full access to their funds, and regulators have stressed that this was a small, contained failure. However, markets don't trade purely on size, they trade on signal. The fact that a bank has failed at all, especially so early in the year, has reignited concerns about stress points in a higher rate environment. According to reports, the failure will cost the FDIC's insurance fund close to $20 million. And while that's manageable, it arrives at a time when unrealized losses across the banking system are still estimated to be in the hundreds of billions. What's notable is that this bank failure coincided with sharp moves not just in crypto, but also in gold and silver, both of which sold off hard. That tells us this is a broader liquidity and positioning event, not a crypto-only problem. When multiple asset classes that are often seen as hedges all sell off together, it usually points to forced selling and de-risking, rather than a fundamental collapse in any one market. So when you put all of this together, leverage being wiped out in spectacular fashion, regulatory uncertainty resurfacing in Washington, and the first U.S. bank failure of the year hitting during an already fragile moment, it becomes much easier to understand why markets look the way they do today. Another important shift we're seeing today is happening quietly in the derivatives market, and it's something traders are taking very seriously. According to market data, bets on Bitcoin falling below $75,000 are now nearly as popular as bets on Bitcoin moving back towards six figures. That's a major change in positioning compared to just a few weeks ago, when upside calls completely dominated the options market. Sean Farrell, head of digital asset strategy at Fundstrat, summed it up by saying that what we're seeing now is traders no longer assuming dips are automatically short-lived. He said the market is pricing in the possibility of a deeper corrective phase before any sustainable recovery, particularly as liquidity remains tight and volatility elevated. In other words, this isn't blind panic, but it is caution. Derivatives desks are reporting a surge in demand for lower strike put options, which are essentially insurance bets against further downside. That kind of positioning doesn't mean traders are convinced Bitcoin is heading straight down, but it does mean they're preparing for that scenario rather than ignoring it. Historically, this kind of balanced positioning, where downside and upside bets coexist, tends to appear during periods of transition when the market is trying to find its footing rather than trend aggressively in one direction. At the same time, institutional flows are sending a similar message. Over the last session, nearly $800 million has been pulled out of crypto exchange-traded funds, spanning both Bitcoin and Ethereum products. BlackRock's Bitcoin ETF recorded the largest outflows, with Ethereum ETFs also seeing meaningful redemptions. This isn't retail panic selling. This is large pools of capital actively reducing exposure. James Butterfill, head of research at CoinShares, noted that these ETF outflows reflect a broader de-risking move, rather than a loss of belief in crypto itself. He said institutions are responding to macro uncertainty and rising volatility by trimming positions that are easiest to reduce quickly, and crypto ETFs fall squarely into that category. Once money leaves these products, it directly impacts spot demand, especially during periods of already thin liquidity. What makes this notable is timing. These outflows are happening alongside leverage liquidations, regulatory uncertainty in Washington, and stress headlines from the banking sector. When all of these factors line up, it creates a feedback loop where reduced institutional demand amplifies price moves caused by forced selling elsewhere. None of this guarantees where price goes next, but together, derivatives positioning and ETF flows tell us one thing very clearly: the market has shifted from complacency to caution. That doesn't automatically signal a top or a bottom. It signals a reset in expectations. And as uncomfortable as that is in the moment, resets are often what markets need before they can move forward again. That doesn't mean prices can't go lower from here. It also doesn't mean this is the start of some guaranteed collapse. What it does mean is that the market is being forced to reset expectations, flush excess risk, and reprice uncertainty all at once. These are the moments that feel the worst in real time, but they're also the moments where structure starts to matter more than noise. Remember, the market doesn't owe anyone easy money. And yet, despite everything we've seen today, the red screens, the liquidations, the fear, the long-term story remains unresolved, still being written, still contested. Drop your thoughts in the comments. Are you sitting tight, accumulating slowly, or stepping back for now? Either way, we will be here with you every step of the way. And, as always, we will see you at the top.